Have you ever wondered why some people love credit cards while others say they're dangerous? The truth is that credit cards are neither good nor bad. They're just tools. But if you don't understand how they work, they can become one of the fastest ways to get into debt. In this video, I'm going to explain exactly how credit cards really work, how banks make money from them, and how you can use them without falling into the debt trap. Let's start with the basics. A credit card is not your money. That's the first thing you need to understand. When you use a credit card, you are borrowing money from the bank. The bank pays for your purchase today, and you promise to pay them back later. Think of it like a short-term loan that you can use over and over again. For example, imagine you buy a new phone for $500 using a credit card. You didn't actually spend your own money. The bank paid the store. Now you owe the bank $500. Simple. But this is where things get interesting. Every credit card has something called a credit limit. A credit limit is the maximum amount the bank allows you to borrow. If your credit limit is $1,000, you can spend up to $1,000 before the card stops working. The limit exists because the bank is taking a risk by lending you money. The better your financial history, the higher your limit may become. Now let's talk about the billing cycle. This is where many beginners get confused. Your credit card doesn't require payment immediately after every purchase. Instead, the bank tracks all your spending during a specific period called a billing cycle, usually around 30 days. At the end of that period, the bank sends you a statement. The statement shows everything you spent during the month. It also tells you how much you owe and when your payment is due. This due date is extremely important because what happens next determines whether credit cards help you or hurt you. If you pay the entire balance before the due date, something amazing happens. You usually pay zero interest. That's right. You borrowed money from the bank and paid absolutely nothing for the privilege. This is how financially smart people use credit cards. They treat them like debit cards. They spend only what they can afford and pay the balance in full every month. But many people do something different. They only pay the minimum payment. And this is where problems begin. Let's say you owe $1,000. The bank may tell you that your minimum payment is only $25. That sounds easy. You might think, great, I'll just pay the minimum. But the remaining balance stays on the card. And now interest starts accumulating. Interest is basically the price you pay for borrowing money. And credit card interest is often very expensive. Sometimes 20%, 25%, or even more. Imagine carrying a balance month after month. You could end up paying hundreds or even thousands of dollars in interest. That's why credit card debt becomes so dangerous. The minimum payment keeps you comfortable today while making your future more expensive. Now let's talk about something called APR. APR stands for annual percentage rate. This is the interest rate your card charges if you carry a balance. Many beginners ignore this number when choosing a card, but it's one of the most important details. A higher APR means more expensive debt. A lower APR means cheaper debt. Of course, the best strategy is simple. Pay the full balance every month and the APR won't matter very much because you won't be paying interest. Now you might be wondering, if people can use credit cards without paying interest, how do banks make money? Great question. Banks make money in several ways. First, they earn interest from people who carry balances. Second, merchants pay processing fees every time you use a card. Third, some cards charge annual fees. So even if you never pay interest, the bank is still making money somewhere in the system. This is why banks love credit cards. Now let's discuss one of the biggest benefits of using them correctly: building credit. Every time you use your card responsibly and make payments on time, you build a positive credit history. Over time, this can improve your credit score. A higher credit score can help you qualify for loans, apartments, mortgages, and better interest rates. This is one reason why many financially successful people use credit cards regularly. Not because they need debt, but because they understand the system. However, there are some common mistakes you should avoid. Mistake number 1. Spending money you don't actually have. Just because the card allows you to spend doesn't mean you can afford it. Mistake number 2. Missing payments. Late payments can damage your credit score and trigger extra fees. Mistake number 3. Maxing out your credit limit. Using too much of your available credit can hurt your credit profile. Mistake number 4. Thinking rewards are free money. Cash back and travel points are great. But if rewards cause you to spend more, you're losing money, not saving it. Here's a simple rule that can keep you out of trouble. If you can't afford to buy it with cash today, don't put it on a credit card. This one habit can save you years of financial stress. The goal is not to avoid credit cards. The goal is to understand them. Used incorrectly, a credit card becomes a debt machine. Used correctly, it becomes a financial tool. That's the difference. The main idea is simple. A credit card is borrowed money. Pay the balance in full every month. Avoid unnecessary debt. Build your credit history. And let the card work for you, not against you. Don't forget to subscribe and see you in the next video.